Welcome to another episode of Quants Worth Following. Today we have a special guest, William Mann, who is the founder and CEO of HarmoniQ Insights, a research and analytics platform built to empower institutional investors with high-quality, transparent insights. With almost 3 decades of experience in the financial industry, Bill previously held senior roles at Two Sigma, AQR, Bloomberg, and AIG. He has both a CFA and CPA designation and brings a unique blend of quant rigor and strategic insights to every conversation. Today, Bill is focused on building tools that demystify complex financial data and improving decision-making across capital markets. I actually met Bill last week at the Fordham event in New York, and we caught up and I was like, it'd be great to have you on Quants Worth Following. And so really grateful to have you today, Bill.
Thank you for having me.
Yeah, likewise. So I'm curious, you were at AIG during one of the most pivotal moments in modern financial history. Could you walk us through the moment you first realized, something might be seriously wrong? And what were the early indicators internally that AIG might be in trouble?
Sure. I can actually tell you the exact moment because I was sitting next to my boss. It was just a big open floor. So my boss and I sat next to each other, and he sort of looked over at me with a very concerned look and said there was a collateral call on the super senior CDS. And super senior CDS were an instrument that were, basically meant for regulatory arbitrage. There was never in any model, any expectation that you would ever have a loss. So it was above the AAA rated tranche of a bond. And, banks basically went to AIG to try and defease their credit risk, and then they could get more regulatory capital relief. And there were other reasons why companies would trade away this basically riskless asset to AIG. But, there was an expectation that you wouldn't market to market. There would never be a collateral call. There would never be a credit event. And in fact, we had been sort of arguing with our accountants for years about the mark-to-market nature of these things. We just wanted to account for them as fees. So basically, you got paid a floating rate over the life of the contract, and there was no mark-to-market. They were always at par. But this collateral call meant that our counterparty was marking it to market, and they were marking it down.
Wow, that's just, I can't even imagine what that must have been like. And just for context, by the way, for everyone here. So, when I was talking to Bill last week about this, and I mentioned the Quants Worth Following series, and I said, we like to hear stories that you've never told before. And Bill mentioned, hey, I have this time at AIG, and it's one of the most obviously one of the most pivotal moments in financial history. And I was like, oh yes, it would be great for our listeners to, especially many people who might not have been through that experience or have worked through that experience before, to understand and just hear directly what that was like. So for our listeners who may not have a deep background in structured finance, what exactly is a super senior credit default swap, and why was AIG so heavily exposed to these? What made them seem like a safe bet at the time?
Sure. So I think we'll start off with what is a credit default swap. So a credit default swap is similar to a put option where if there's a default on a bond and you've entered into a CDS with a counterparty, you're able to put that bond to them. And so basically it allows you to defease the credit risk of a bond. And back in the 90s, when, they were first invented, out of JP Morgan, there are probably some articles you can find about the birthplace of the CDS contract that would refer to the JP Morgan mafia, I believe. Swaps have been around for a long time, similar to an interest rate swap. You pay a floating rate, and then this is a contract that only pays off in the event of a default. So the fixed leg is really just default. You put the bond to the person who wrote you the contract, and that's why they're also sometimes referred to as insurance-like instruments. So it gives the holder the benefit of owning a bond and then defeasing the credit risk. And you pay a floating rate on the CDS, you earn a floating rate on the bond, or a fixed rate. You can basically still earn a spread and defease the credit risk. And then they became very powerful risk transfer tools for banks and financial institutions that needed regulatory capital relief. So basically, the bank's dollar of capital for every, X percent of your assets and liabilities. And, there's a calculation you go through. And basically, if you've defeased your risk with paying out cash as a bank, you don't need to hold capital. So that's one use of a credit default swap. You can also use them as a way to just have synthetic credit exposure to bonds. So you can buy CDS and sell CDS and effectively have the same economics of holding a bond, but you may not need to actually have the operations or other mechanics of holding an actual bond where you have to have systems that can process cash flows and coupons. But anyway, so that's a credit default swap. And then a credit default swap on a super senior tranche of a CDO is specifically what we're talking about here. So collateralized bond obligations and then later collateralized debt obligations are pools of fixed income instruments, bonds that you issue debt against. So in order to buy the bonds, you can issue debt and then tranche your bonds to give different risk to different buyers of this instrument. And so the rating agencies and the banks would set these up, and you would have a AAA rated tranche, you would have a AA, single A, triple B, and then down to double B. And then eventually there was an equity slice where, the most significant risk was. So if there's a default on one of the bonds in the portfolio, the equity loses their value. If there continue to be defaults, it will start eating into each of these tranches. But if you model the chances of every bond defaulting on its debt, eventually the AAA should still get everything back because there will still be enough bonds that are paying to pay them back. Of course, there eventually was what was called a super senior tranche. So it was actually above the AAA. And you can kind of think of this as a stack that you break it down percentage wise. And maybe like 80% would be where the AAA starts. So 80% of the bonds have to all default and be kind of worthless for them to suffer a single dollar of loss. And then super senior would be above that. So it's more like 90 or 95% of all of these bonds would have to become worthless for you to ever actually suffer a loss. And these credit default swaps were written in that way. So unless every bond defaults and 95% of the collateral is blown out, AIG never pays out a dime. However, what we've found out is there's more to this than credit risk. And, eventually the leader of our unit, who was a very colorful individual, was actually criticized quite a bit for saying that he didn't see there being any chance that we would ever suffer a loss on these contracts. And technically it was true if you thought about that math and the models that helped us get comfortable with this risk. And then what made them seem like the safe bet at the time, it was really just, your classic model risk assessment looked very good. We were getting paid to hold what was essentially a riskless liability. And part of the reason for that was AIG had a AAA credit rating. And so they were a perfect counterparty because for capital relief purposes, there was no chance, no one would ever question whether or not AIG could pay you back in the event of a default. So this was very much a regulatory arbitrage type of trade at the height of what was really then a bull bond market and a housing bull market that then led to mortgage-backed securities becoming very highly in demand, and then eventually subprime mortgages. And eventually these different RMBS and CMBS ended up in these pools, CDOs. And eventually AIG ended up having some things that had real credit risk, but there was still very, very little likelihood that we would ever have suffered actual default and, needed to buy this bond that was defaulted.
Wow.
Hopefully that all makes sense.
Yeah, absolutely. Maybe to expand upon that for our audience here, one of the key misconceptions during the 2008 financial crisis was the confusion between credit risk and liquidity risk. So Could you explain the distinction for everyone and how that confusion played a role in AIG's unraveling?
Certainly. A lot of people were confused by the difference between credit risk and liquidity risk, unless you had been through a similar thing in the past. So the longer you've been around on Wall Street, the more likely you are to have witnessed a run. And, a run on the bank is liquidity risk when your counterparties or your depositors pull their cash and they say, we're no longer interested in doing business with you. All banks are levered by their nature. They take $1 of deposits and they may make $2 worth of loans. So if all of their depositors want their money back, they've already lent it out. So effectively, there is always a liquidity risk with any bank. And, this whole concept is on display in the movie It's a Wonderful Life, I believe. And, the Great Depression itself was really just a run on the bank in 1929 when everyone said, I don't really trust that these banks are going to have my money. I'm going to go and withdraw it. And so that's, at the heart of it, what liquidity risk really is. It's that people no longer want to do business with you and you have leverage. So you default, you become insolvent. And Bear Stearns became insolvent over a weekend in March of 2008. And then Lehman Brothers became insolvent in early September of 2008. And then AIG followed within weeks. And eventually there was a bailout within days. And so the whole financial system was effectively insolvent. And the real difference here was, like I said, we didn't really have credit risk. AIG wasn't really exposed to credit risk unless every mortgage-backed security defaulted, even from places like WAMU and these like subprime mortgages. Like there was still so much collateral in this pool that eventually the AAA would get paid their par at the end. We would rip up the contract and say, okay, we no longer have to, in any scenario, pay out on this bond. But the mark-to-market risk was, just a standard ISDA, like in the International Swap Dealer Association contract, is you pay a dollar for every dollar of mark-to-market risk that you owe the other counterparty. And I don't think AIG, FP senior management, or AIG really understood that there was a scenario where AIG would have to pay out a lot of cash collateral for the mark-to-market on these contracts. And I guess I'm not sure if we are going to ask, but eventually AIG owed, well, they had actually posted, so they no longer really owed it, but the banks were holding like $33 billion worth of collateral on this book of CDS contracts. And that was ultimately like they ran out of money after 33 billion. And then I could get into what AIG was actually doing, and they had their own liquidity problems. They had their own, what I would call a repo pyramid, where if you own a bond, you can lend it out and get cash. And you can take that cash, buy another bond, lend that out and get cash. And then eventually sort of wind this book up and lever up just bonds. And those happen to also have lots of CDOs, which no one wanted. And then so to unwind these levered products, they essentially had to do the same thing and post collateral to all their counterparties at the exact time when you don't want to. And yeah, so liquidity risk was substantial. And the flip side of that is all of the banks that were holding $33 billion worth of collateral from AIG had a lot of liquidity risk to AIG, and no one really saw that coming, especially with the AAA credit rating.
Oh, absolutely. And I guess along those lines as well, I know a lot has been said about the Fed stepping in to stabilize AIG. Could you maybe break down how that solution came together? And would you characterize it as sort of like a backdoor bailout? Or do you think that's an oversimplification of what actually happened behind the scenes?
So it might depend on when you ask me and how I'm feeling about the situation. It certainly was a backdoor bailout when you contextualize it in that way. But it certainly would be an oversimplification of what happened because, in my view, it was sort of an elegant way of wrapping up a lot of problems that were really difficult to understand in a weekend. And so what happened is the government eventually came in and backstopped a lot of investments that would essentially scare people off. And, there were money market funds and things like that you could always get par. You could always get them out, get your money back in a day. And that's like daily liquidity funds like mutual funds and things like that. There's basically always a guarantee that you can get your money back today. And some of those types of things started to look shaky when the issuer of those instruments would be in trouble. So if you look at Lehman, I think it had a portfolio, like a money market fund that broke the buck. And basically, you couldn't get your dollar back if you asked for your dollar back that day. But AIG had these credit default swap contracts that, basically we were going to, in theory, wait around until, 3 years passed. And the maturity of these bonds could actually change too, because there's a prepayment speed and there's interest rate risk and all sorts of other stuff. But effectively, like 3 years, you kind of wait and there's no defaults and all of that collateral comes back, right? Because there wasn't actually a loss. They don't give the bond to us. And in the event of a default, you actually have to buy the bond. So in theory, if AIG remained solvent, you would just unfortunately have all of your cash at the banks, but eventually it would all come back. And so economically, that was the right thing to do, especially if AIG was now supported by the government. And it effectively was, because they backstopped like AIG's liabilities. They eventually owned the company outright and all the equity. But what they chose to do instead was take all of the contracts, rip them up, buy the bonds from the banks. So they took all the bonds from the banks' balance sheets and put them into a trust called Maiden Lane. And I remember saying, like, oh, Maiden Lane, there was Maiden Lane 1, Maiden Lane 2, Maiden Lane 3. Maiden Lane 1 was Bear Stearns and its CDOs. So the Fed had effectively done this once when JP Morgan bought Bear Stearns. They said, okay, you can buy Bear Stearns, but we're going to take this off of your hands. And that's, I guess another like little known secret. It's kind of bailout-ish. So rather than let Bear Stearns go bankrupt and then, have all the problems that we later saw with Lehman, the government did assist JP Morgan in that transaction. But Maiden Lane 1 and Maiden Lane 2 were basically trusts where they took all of these bonds that no one wanted. They were like subprime mortgage-backed securities and CDOs of CDOs. And I believe Maiden Lane 3 was the synthetic side. Maiden Lane 2 were the cash-based bonds. And so Maiden Lane 3 were effectively the bonds that were issued by the people that made a lot of money in the credit crisis. So I forget, it's presumably Michael Lewis's book covered this, but the banks, and I won't name names, but one in particular that did a lot of what were called synthetic CDOs, wrote credit default swap contracts on behalf of these people. And they would pick out, like, I want that bond issued by Washington Mutual or Countrywide, which were the subprime mortgage issuers. They would put them in the CDO and then ask AIG to defease the risk with a credit default swap. This bank would sit in between and say, okay, we're going to owe collateral to these people that are going to make a lot of money. They were the big short people. And then on the other side is AIG. So basically, they make a lot of money. And the people in that book that got rich got AIG's cash, which in theory, again, would have come all the way back at some point. And the bank, I think in that case, would have suffered more. But effectively, they were just playing market maker between someone who wanted to get exposure to something that was going to blow up. And AIG, unfortunately, ended up holding the bag. So the government came in, they said, we're going to rip up these contracts, buy all the bonds, even though that's not economical at all. That's like the last thing you would want to do, like buy these bonds. And then eventually, I think the banks got to buy them back at what became a higher price, but there was still par. So the banks sort of got to make money twice on these
Wow.
ugly bonds.
Yeah.
So, like when you think about it in that sense, it is kind of a backdoor bailout because
Yeah.
at the time the banks desperately needed that liquidity. And so they basically got to sell bonds that no one would have wanted for, $33 billion spread across the entire market. And you could argue if at the time this had sort of gotten out into the press, you would have had the same outcome, right? Like people would have found out that the very largest banks actually had $10 billion in risk to AIG, which was now insolvent. But that was quietly done over Thanksgiving weekend in 2008. So
Wow.
the whole weekend was all about like, let's rip this up, get this stuff in there. And then on Monday, we'll announce that, this is effectively over and we'll leave the details for later.
Wow. Looking back now, what cultural or institutional dynamics at AIG do you think contributed most to the crisis? Was it a breakdown of internal controls or maybe groupthink or some kind of incentive structure or I don't know, a bit of everything?
So part of what came out of the whole credit crisis was this, ill feelings for the whole financial sector. And that was like Occupy Wall Street and all these things came out of this. And effectively, what people were mad about is rich people betting their like Main Street retirement on bad things. And, you'd put your money with this bank, you'd think they were trustworthy and they were going to give you your money back. And then you find out that they were actually putting it at a lot of risk. And then there were, of course, individuals who got paid a lot of money to take that risk. And, there is, I think humans and, economic principles are mostly based on incentives. And of course, humans are going to behave as you would expect them to. If you pay them a lot of money to take a lot of risk, they're going to take a lot of risk, especially if it's not their own risk. So when Goldman Sachs ceased to be a partnership and became a public company, I think behavior changed significantly when it was, this is my own ownership in this company. I'm going to protect it differently than if the public owns it and I can effectively like already have my money if it's gone public, et cetera. So the whole banking industry had reached this place where no one really had to worry about the default. It was the bank's problem. And so regulation changed quite a bit. And I think incentive structures were kind of misaligned, but I think you still see that like everywhere. I would argue that tech companies now have some misaligned incentive structures, and corporate governance is kind of an art rather than a science. So there were corporate governance issues at AIG in particular. So our unit was sort of standalone and it was very complicated. And I think that they ultimately didn't really understand what was going on there. AIGFP got to keep 30% of its profits and they would give the rest to AIG. But we were actually making money from doing transactions with AIG. And so there were conflicts of interest and ultimately, I think, misaligned incentives to hedge the credit risk, to hedge that, $500 billion in notional super senior credit risk would have been extremely cheap in, right before Bear Stearns blew up. So think about March of 2008. I think they could have basically taken care of the whole problem, but they would have given away profits and they would have given away 30% of their bonus, et cetera. So yeah, I think it is a bit of everything. And I think the overall financial system is more stable now. But, you know, a lot of people are still taking too many risks and hopefully, everyone is a little bit more aligned with the risk of their institution and a lot of people own more stock in the company they work for and things like that, which should take care of some of this.
Absolutely. Yeah. I guess curious, what was it like for you being at AIG? What was it like for you personally being at AIG throughout the financial crisis? Did work resume as usual or was your work disrupted? Like, what was that like?
Oh, it was very disruptive. And, there was effectively like a year of running around, putting out fires, dealing with this problem before the rest of the world even knew. So, you know, I said August of '07, Bear Stearns was March of '08. So that's like a, 6-month period where the whole world was still kind of chugging along, and like there were liquidity problems and people started to see them more in the fall. I remember heading into the holiday season, like I think we were more worried than most, and we were headed for a recession, but uh Bear Stearns, and then things keep getting worse and they keep getting worse, and every month we're posting more collateral. So eventually, that was like a year of not very fun times. And in fact, to keep us around, AIG gave us retention contracts because the moment we paid all of this collateral out and realized these losses, we effectively had no bonus pool. And everyone that worked at AIG FP had their salary capped. And so all of your comp was in bonus. And so what a lot of people don't understand and understandably criticize is like these big bonuses that were going out to everyone were guaranteed, but without a guarantee from AIG, no one would have stayed. Like I effectively couldn't have paid my bills with just my salary. So it wasn't fun. And then when the government came in and the public outcry started, and Congress started complaining, and even President Obama and Ben Bernanke were on TV like directly criticizing the 400 people up at our unit up in Connecticut and kind of characterizing us as demons. Eventually there were people picketing on my coworkers' front lawns. Like thankfully I didn't have the mansion big enough. I shouldn't say thankfully. I guess I still wish I had the mansion, but there were people like picketing on their home residences, and no one likes to go through that. So it was very messy, and I was kind of happy to say goodbye when I did.
Oh my goodness. I can't imagine what that was like. And maybe also curious from your perspective, at the time, was there any communication from leadership as well? Was it reassuring? Did they tell you anything? What was, going on?
Yes. So if you're really interested in reading about this, I would try and find an op-ed written by one of my coworkers named Jake DeSantis. And I think it was called Dear Ed Lady, I Quit. And, effectively, they fired the CEO of AIG pretty early on. They fired the CEO of our unit and then gave him a contract to stick around, but he effectively was gone. And then eventually the government placed someone in as the new CEO, and his name was Ed Liddy. And he was trying to do what was right. I think he was coming out of retirement from working at an insurance company to basically do the right thing for the government. But then he wrote us a letter and said, we think that these guaranteed bonuses that are owed to you are distasteful, and we want to give you the opportunity to give your money back. This was after they had reassured us on multiple occasions and written us letters like, yes, we'll still honor these contracts, even though we effectively went insolvent. And then all of a sudden, like, and everyone's paranoid about this, it's in the press and everything. And then eventually they said, we want you to give your money back. And then the day they owed us our money, it didn't come. So we were sort of nervous over the weekend. Is this going to come? And so, yeah, eventually I had a distrust for AIG corporate, which was also the Federal Reserve, effectively because they were owned by the Federal Reserve. And clearly, like the people that were asking them to write us a letter like that after multiple times telling us that they would honor a legal contract. So yeah, I had some distrust for several players.
Wow. After AIG, you spent 4 years at Bloomberg, 3 years at AQR, and then 8 years at Two Sigma. If you had to distill one lesson for today's financial institutions from what happened at AIG, what would it be? And are there any red flags in today's market that feel eerily familiar to you?
So I think it's probably always the same thing, in hubris and incentives start to go hand in hand, and I think that people fail to see risks that they don't want to see eventually. And so there was this famous quote from Chuck Prince at Citi who said something to the effect of, we'll keep dancing until the music stops. It's almost like a musical chairs reference. And I don't think he completed the thought. Like someone always falls down when the music stops in musical chairs. So like that's not a great risk management process. And I bring that up just because I think it was very indicative of how people were thinking at the times. There was like, we can't miss out on more upside, the thing's going up and up and up. And when I look at the stock market over the last 17 years since the credit crisis, there's been a lot of government support for assets worldwide. And everyone's gotten used to the market just going up and up and up. And I remember thinking a lot of the people that are coming out of school and onto Wall Street have never been through a real recession or a real big sell-off. And of course, COVID happened, which I would argue is one of the craziest things that will ever happen in my lifetime on and off Wall Street. But then, of course, that was, a month long, maybe a quarter long recession because the government came in again and bailed everything out. But if I were to look at one place where I don't think people are effectively assessing the risk, it would be in the newer structured products that are available. And they're even available with more liquidity than ever now. So, an easy example would be you can buy a high yield bond ETF. Well, high yield bonds in the past used to become illiquid. Like when everyone got scared of bonds, they would stop trading and then the prices go down and eventually, you find a mark. But effectively, it can become illiquid. And I think if you own HYG and there was a real bad credit cycle, I don't think you would get your dollar back. Eventually something like that could blow up. But right now, I think the real risk is in like the options market with a lot of these structured products that are out there, the triple levered ETFs. There are vehicles that are promising outsized returns with very little risk. And it's kind of like this low vol trade that have burned quants in the past, where if historical volatility is low, you typically go longer with your leverage. Like you feel more comfortable with the risk because everyone uses volatility as a proxy for risk. But if the volatility of the pricing of an asset doesn't reflect the actual risk, you can bet too much on it. And, there are classic examples, and I won't get in. We could probably talk about this for a long time, but I do think that, there will probably be some mismanaged vehicles out there that are really in the publicly traded equity markets that in the event of, and I guess maybe we survived the tariff tantrum or whatever we're going to call that, but, unwinding some of these levered trades that are really leverage on leverage. So you can buy options on a triple levered ETF, which uses options. And so I think a lot of people are holding these things overnight. They're not meant to be held overnight. And I think since there hasn't been a real blow up, people just get too comfortable. So that's where I would keep my eyes out if I was looking for a potential lesson to learn.
Amazing. Thank you for sharing that. And now jumping to the present, what led you to start HarmoniQ Insights?
Sure. Thank you for asking. When my period of, basically sitting out with a non-compete with Two Sigma expired, I decided I wanted to try and share my expertise in more of an advisory and consulting capacity. So I originally set out to work with buy-side clients, and then I found that I'm advising a lot of just different companies that are within the quant ecosystem. So I work with a lot of fintech companies, a lot of data providers like, Databento even, and I can be almost like a referral agent at times. And it's kind of fun being in the startup space. And that was the real reason I set out to try something on my own. And it's been a pretty satisfying endeavor becoming an entrepreneur. And I wasn't very familiar with promoting myself on social media and things like that. So it's interesting. People will say, "Oh, I've seen you posting a lot on LinkedIn lately." And if you looked at my traffic since I started HarmoniQ Insights in September of last year to now, I bet I've posted 5 times as much as I had the previous 15 years combined. And so that's been kind of interesting to learn how a lot of different things work. And it's been fun though. I like going to conferences and meeting people like you and doing things like this. I have a podcast as well, and I've enjoyed that quite a bit.
It's amazing. Yeah, I was going to say same with, when you go into the startup world, it's like you have to do sales and marketing for the first time. And it can be very, for me, very disorienting having to post on social media as a part of my job description almost. So I can definitely empathize with that insight and that feeling. As a final question, do you have any advice for the next generation of folks in the financial services industry?
That is a really good question because the world is changing very fast. And, while I do think that my, like you said, 3 decades, that makes me feel pretty old, experience on Wall Street is valuable, some of it is less applicable now. So when I started, you had to fax confirmations for trades around, and sometimes contracts and things like that needed to be like transferred almost manually. So obviously those types of things aren't around anymore. But the big change now is like AI, and in my space, like HarmoniQ Insights and our podcast, New Barbarians, talk about tech disruption in finance and in Wall Street. And so a few years ago, you had to learn how to code. And, in particular, learning Python was a very valuable skill. And what I used to tell people there was like, data can still be bad. You can have great models, bad data, garbage in, garbage out. And that's, part of what happened at AIG too. I referred to these credit models that didn't really think about liquidity. And so you can have a good model, bad data. You can have a bad model, obviously, isn't going to do well even with bad data. So I think don't trust the machines entirely, especially when it comes to data. And I think that if you want to succeed as like a new entrant into one of these new disruptive tech types of roles, don't be ashamed to take on some of these more burdensome roles by definition, such as building data pipelines. It doesn't sound very interesting, but it's so valuable. And, people like me will always value that a lot. And if you come in and say, oh, I know how to run machine learning and AI models, I know the latest and greatest things about, neural networks and deep learning, I'll be impressed. And, it's great that you must have a very good math mind, but there are a lot of people with that skill now. And I think increasingly less with, database management and sort of outlier detection and cleaning bad data and things like that. So I would encourage people to learn from some of their like mentors that have been around for a little while and realize that learning the basics and just reconciling data and things like that don't seem very interesting, but they're just as important as they ever were. I find mistakes with multiple LLM models all the time, and you can't trust the machines entirely yet. Maybe someday we won't need to be involved in the decision making process of managing money and things like that, but that's nowhere near close. And especially when machines are going to be trained on, more recent data, they haven't seen the credit crisis and seen the way things behave in that sort of an environment. So I'm very skeptical of quantitative models and data in particular. So try and train yourself to be skeptical and willing to do some of that hard work that is necessary to learn in order to appreciate some of these things.
Yeah, I was going to say, like, this is a common lesson that, pretty much everyone I interview says is, half of a quant's job is wrangling data and learning to not trust the data and, fixing things in the data pipelines and going from there. So yeah, absolutely. That's a really fantastic lesson that I think reverberates across everyone in the industry. So thank you again so much, Bill. It's been a pleasure to have you here today. And thank you for sharing more about your experience at AIG and beyond. Hopefully, it'll be great lessons learned for everyone out there. And also just really wonderful to have you on as well. So yeah, I hope everyone enjoys the rest of their day, and we'll see you at the next episode. Goodbye.
All right. Thank you.